Welcome to Breaking News to Trading Moves. Today, our goal is to look closely at a key market movement. We want to really break down what that movement tells us about the broader landscape, specifically for electric vehicles and all the companies involved in that whole ecosystem. We're focusing on some recently released data about Tesla's performance over in China. It's a really critical market. And this isn't just about, one company's results. It's more about what this localized change means for lots of connected segments. We're talking domestic rivals, global battery suppliers, even charging networks over here in the US. The core headline, the main finding, is pretty stark. Tesla's retail sales in China have fallen to a 3-year low. This data point really captures a moment of, well, intense competition in what's probably the world's most dynamic EV market right now. So let's start by getting the scale of this contraction out there. Tesla's retail sales in China for October, they dropped to 26,006 units. That number just on its own represents a 75.8% fall compared to the same time last year. But maybe what gives the clearest picture of the competitive situation is the drop in market share. Tesla's share went from 8.7% in September.
Which was pretty solid.
Right, 8.7%, and then it dropped steeply down to just 3.2% in October.
Wow, 3.2. That's fast.
Incredibly fast. It really represents an astonishingly quick reordering of market standing in just, 4 weeks. It immediately makes you ask, is this just a blip, a momentary thing, or is it evidence of a more structural problem when facing this really localized competition?
Yeah, that speed of market share erosion you mentioned, that is precisely the critical takeaway for anyone watching the EV space. It's really impossible to overstate how important China is in this whole equation. It is Tesla's second largest market globally. It's home to their highest volume production facility, the Shanghai Gigafactory. So when demand softens, even locally in a market of this size, it creates these immediate, very tangible pressure points. And they extend far beyond just the local sales figures. They affect the entire electric vehicle ecosystem worldwide. The material we looked at suggests there are two distinct pressures coming out of this situation. The first is kind of internal to the company affected, the potential pressure on their global pricing strategies, maybe having to make adjustments to their product mix, and most critically, pressure on profit margins for the EV sector leader. When you lose that much local volume, the immediate reaction is often, aggressive pricing action, right? And that's a mechanism that tends to erode profitability.
Right, cuts into the margins.
Exactly. And the second pressure point is the acceleration of market share capture by those domestic, often very cost-competitive Chinese brands. Their success is essentially, it's the mirror image of Tesla's localized struggle. This dynamic forces everyone to reevaluate market leadership and, importantly, local consumer preferences. It seems to indicate that the Chinese buyer is pretty quickly moving toward these domestically manufactured alternatives.
Okay, so let's focus a bit more on the mechanics of this contraction. We have the data point, that 35.8% drop in retail volume down to 26,006 units for October. What does that reduction in units actually mean when you look at it against the backdrop of the Chinese auto market right now?
Well, it means roughly 14,500 fewer vehicles were sold to Chinese consumers compared to the year before. And this happened during a period when the overall EV market there, while, yes, highly competitive, is still generally expected to show long-term growth. So it's not like the whole market just collapsed.
And that market share data falling from 8.7% down to 3.2%, that's arguably even more telling than the absolute drop in volume, isn't it?
I think so.
A 5.5 percentage point loss in share in just 1 month. It suggests it's not just a temporary dip in enthusiasm, maybe. It points to a successful, aggressive campaign by competitors to grab those customers.
It really does. It doesn't look like the overall market shrinking proportionally. It looks much more like specific domestic competition expanding rapidly, filling the space that the foreign brand seems to be vacating, at least for now.
So the decline really confirms that customers who might have picked the foreign EV option are now clearly selecting alternatives, and at a pretty significant pace.
And this brings us to a really crucial point about the local versus the global dynamic. This is where the analysis reveals something quite thought-provoking. A bit of a paradox, actually. While localized Chinese demand for Tesla was, undeniably weak in October, those sales numbers make that clear. The exports from their Shanghai facility actually reached a 2-year high during that very same period.
Hang on, a 2-year high for exports? That seems to, well, it challenges the idea of some kind of existential crisis in China, doesn't it? If the Shanghai factory is hitting export highs, it suggests the production process is still efficient, the product itself is still in demand elsewhere. Are we maybe putting too much weight on fierce competition? If this could just be a temporary logistical choice, maybe shipping cars overseas to smooth out quarterly delivery numbers, or perhaps just a temporary inventory correction inside China?
That's a very fair question.
Mm,
And it really requires us to parse the difference between a production issue and a demand issue. The high export volume is critical because it tells us the production capacity of the gigafactory remains robust. They can clearly make vehicles at a high rate. No problem there. However, the fact that such a large volume had to be diverted overseas, the key signal here is the diversion that strongly indicates that the preference, or maybe the purchasing power within China itself, is lagging quite severely. That lagging demand necessitates the push into global markets. If local demand were strong, you'd expect those cars would stay in China.
Okay, so the high export mix is acting like a compensatory mechanism for weak local sales.
Precisely. It proves the issue is genuinely one of local competition and maybe waning consumer appeal right now, not a factory bottleneck or some kind of manufacturing flaw.
So the company is efficient at making the car, but maybe less efficient right now at convincing the local Chinese consumer to buy it. What's the specific context driving this weakness in localized demand?
Well, the analysis points to two pretty persistent and powerful headwinds that are creating this intensely pressurized environment. The first, as we've noted, is that fierce domestic competition. Chinese manufacturers are highly localized, they're agile, and they seem to be engaging in really effective price wars and feature stacking.
Feature stacking.
Yeah, adding more tech, more perceived value, often for less money. They respond to market signals with a speed that a globally centralized company often struggles to match.
Okay, so speed and localization. What's the second headwind?
The second is a broader overall softer trend in China's total auto sales. So when the whole pie isn't expanding as fast and the domestic competition is eating a larger portion of it, the foreign brand tends to struggle disproportionately.
Makes sense.
And to really understand the domestic competition, you have to look at their approach. They aren't just matching prices, they're aggressively adapting features specifically for the Chinese consumer. Things like advanced localized connectivity systems, massive high-resolution screens inside the car, features like LiDAR technology being integrated into standard production models much more quickly.
Things that maybe aren't prioritized as much globally, but resonate locally.
Exactly. The consumer there is being trained, essentially, to expect rapid technological updates and higher content for a lower price. This constant high-speed iteration by the domestic players creates tremendous pressure on a competitor whose models typically run on longer, multi-year product cycles.
Right, a global model refresh takes time.
Much more time. So that high export volume, while it does stabilize the global production figures, it confirms that this compensation strategy is in effect. But it doesn't really resolve the core problem, which seems to be falling local appeal and the intensifying agility of the domestic players.
Okay, so we've kind of identified the strain point here. Now let's turn our attention to where the capital and the consumer preference seem to be flowing. The softening of sales for a major foreign EV maker, well, it creates these pathways for success elsewhere, doesn't it?
It certainly seems to.
The data we reviewed points to three specific categories of winners, companies or groups that are structurally poised to benefit from this reordering of the Chinese EV landscape. This transfer of preference really highlights how the market immediately rewards companies that are either meeting that localized demand better or are somehow insulated from the immediate vehicle sales volatility. So, category one, the China native EV makers gaining share. This seems like the most obvious one, right? The mechanism appears to be speed and cost efficiency. These domestic brands are successfully capturing the demand that Tesla seems to be losing, focusing on, as you said, rapid model cycles, maybe vertical integration, and certainly aggressive pricing strategies. They're directly targeting the points where the foreign competitors' local sales are easing off.
Absolutely. And the names highlighted here are NIO, that's NIO, and LILI. Their operational benefits come directly from being right there, close to the consumer, and having a more flexible business structure, perhaps. They seem to possess the speed needed to adapt quickly to local consumer tastes. For example, LI, that's LI again, has really dominated the large family SUV market there, often using extended-range hybrids. That directly meets the needs of Chinese families who value space, but might be cautious about relying solely on public charging, especially for longer trips.
Right, the range anxiety issue combined with practicality.
Exactly. And NIO, on the other hand, differentiates itself through innovative services. Their battery swapping network is a big one. It addresses range anxiety almost instantly, something a foreign competitor doesn't currently offer there.
So different strategies, but both capitalizing on local needs.
And crucially, they manage price elasticity much more effectively. They can adjust pricing, introduce new trim levels, or roll out localized discounts almost instantaneously, it seems, responding to market changes or competitor actions. That gives them a distinct competitive edge over manufacturers whose pricing structures might be, centrally managed by a global headquarters somewhere else.
That concept of the rapid model cycle you mentioned earlier seems key here.
It really is. In a market where connectivity and tech are paramount, being able to refresh or introduce a new feature-rich product every, say, 12 to 18 months rather than every 3 or 4 years keeps these domestic players perpetually relevant. They stay technologically fresh in the consumer's mind.
So when the former market leader sees a 35.8% decline in sales,
It proved that consumers are willing to jump, and jump quickly, to these domestic alternatives, especially when those alternatives successfully match or even beat the value proposition in terms of content and service offered locally.
it sounds less like competing against a single opponent and more like competing against a highly localized, agile swarm.
That's a good way to put it.
The ability to integrate features specific to Chinese traffic patterns or navigation systems or even, things like in-car karaoke suddenly becomes a competitive necessity, not just a gimmick.
Right. The strength of companies like NIO and LI is their demonstrated ability to translate that local demand weakness for a foreign competitor into actual units moved and market share captured.
They're benefiting directly.
Exactly. They seem to be vertically integrating more, controlling more of their supply chain, reducing the lag time between spotting a consumer trend and rolling out a vehicle that meets it. They view the vehicle not just as transport, but as a rapidly evolving digital device. And the market appears to be rewarding this agility and localization strategy, making these names immediate beneficiaries of the sales contraction seen by their foreign competitor.
Okay, moving to the second category of winners. This shifts away from the direct car manufacturing battle slightly and moves into the supply chain for advanced components. Specifically, ADS, that's Advanced Driver Assistance Systems and auto chip suppliers. The analysis suggests this segment is positioned maybe more defensively and is benefiting regardless of which specific brand is winning the local sales contest day to day.
That's the idea.
The core reason they seem to be beneficiaries is that their success is largely decoupled from any single automaker's sales performance. The broader overarching trend in China seems to be that the Chinese original equipment manufacturers, the OEMs, they continue to rapidly increase the amount of ADS and compute content they're packing into each vehicle. They're prioritizing technology integration across the board, making silicon essentially a fixed and growing cost per vehicle.
Right. The component names we're looking at here are MBLY, MBLY, and ONON. Their resilience comes from a subtle but pretty crucial difference in how their products get adopted compared to, say, a raw material supplier. For these suppliers, MBLY and ON, the sheer volume of content per car measured in silicon, sensors, processing power that matters more than the overall vehicle sales growth rate for any single manufacturer.
Okay, so even if the foreign EV brand's local sales soften.
Exactly. The domestic competitors who are picking up that market share, the NIOs and LI, as we just talked about, they are simultaneously increasing the sophistication of their own vehicle platforms.
And we should probably define that sophistication, right? We're not just talking about basic cruise control.
Oh, definitely not. We're talking L2 plus, maybe even L3 autonomous capabilities. That requires redundancy, higher resolution sensors, multiple high-performance processing units. Chinese consumers seem to have an expectation now that their new EV will be a technologically advanced platform. This is partly driven by that competitive arms race among the Chinese OEMs themselves, but also potentially by government policies encouraging smart vehicle development.
So if a consumer switches from a foreign EV to a domestic one,
That domestic EV is likely loaded with an equal or possibly even greater amount of the advanced silicon needed for features like automated parking, high-speed assisted driving, high-fidelity mapping, and so on.
okay, so if the Chinese domestic market is seeing power consolidate among these domestic OEMs, and those OEMs are spending heavily on compute and ADAS content to differentiate themselves,
Then the suppliers of those high-value chips and sensors are essentially shielded to a degree.
the overall market for automotive silicon just keeps climbing, regardless of one specific competitor's sales numbers in a given month.
Precisely. It creates a highly defensive position for names like MBLY and ON. They're capitalizing on the technology arms race being waged between the Chinese OEMs. And that race seems to only be accelerating as competition gets more intense. They're essentially, selling shovels during a gold rush, and the rush continues even if one prominent miner slows down operations for a bit.
Good analogy.
For ONON, which supplies high-performance silicon carbide power devices, their tech is really essential for maximizing the range and efficiency of all these new EV platforms. Doesn't matter whose logo is on the car. And for MBLY, they are leveraged to the adoption of advanced ADRs features, which the Chinese OEMs are deploying aggressively to win those local sales.
Okay, that makes sense. Now, the final category of winners identified brings us to global automakers with strong hybrid portfolios. This seems to be where market pragmatism meets transitional technology. It speaks to the current economic reality for many consumers in China, perhaps.
I think that's right.
The reason for their relative strength, according to the analysis, is that in a highly price-sensitive and maybe infrastructure-constrained market like China, consumers view hybrid vehicles using both gasoline and electric power as a kind of necessary bridge technology. This preference provides a comparative uplift in market sentiment for them relative to the pure battery electric vehicle, or BEV-focused names. It reflects the consumer's practical decision-making over maybe a purely ideological adoption of electrification.
Yeah, the global names identified in this category are TM, and HMC. The strategic advantage of having a diverse drivetrain portfolio seems to be clearly paying off when pure EV adoption hits these localized bumps, whether it's price resistance or infrastructure hurdles. When a consumer finds a pure EV may be too expensive, or they still harbor concerns about charging time or range anxiety on longer journeys.
The hybrid model offers a compelling, immediate alternative.
Exactly. It still gives you fuel economy benefits. It's a partial move toward electrification. But crucially, it doesn't require that full commitment to the still developing charging infrastructure or the high upfront cost that often comes with those large format EV batteries.
We should probably emphasize the affordability factor here, too.
Definitely. Hybrids often need smaller, less expensive batteries. They rely on the established fueling infrastructure everyone's already used to. This flexibility makes them a safer choice, perhaps, in an uncertain economic climate. TM and HHA can leverage their decades of experience and scale in hybrid technology to produce highly reliable, cost-effective alternatives. The analysis suggests the market is rewarding companies that offer this flexibility. They're viewed as better positioned to weather the volatility in pure BEV demand compared to firms solely reliant on pure electric sales.
So it's an issue of reliability, maybe minimizing friction in the buying process.
Could be.
If you, the consumer, face potentially unreliable charging or a high price for a pure EV, choosing a hybrid minimizes that risk while still letting you participate in the electrification trend.
Right. We often talk about the EV revolution in terms of full BEV adoption, but the data coming out of China reminds us that localized affordability and practicality really dictate the speed of that transition. The preference for hybrid technology is a strong signal that maybe not all electrification is created equal in the eyes of the price-sensitive Chinese consumer today. Okay, so now that we've established the winners, the companies or groups benefiting from this transition, we need to examine the fallout. A sales contraction for a major player in the world's largest auto market, it tends to initiate a chain reaction, doesn't it?
Usually does.
So we need to look at which groups are facing headwinds and what are the precise mechanisms of that pressure. First category here, U.S. EV automakers with China exposure, or interestingly, just sentiment ties.
Sentiment ties, okay.
Specifically, we're looking at TSLA, and FF. The reason they're categorized as facing headwinds is pretty straightforward for TSLA, at least. Weak China demand directly increases the margin risk globally for these companies. When a key engine of growth sputters like that, the financial model, which often relies heavily on scale economies, comes under strain.
Makes sense. The volume matters.
Absolutely. And beyond just the direct sales impact, the analysis highlights that this localized softness in China immediately fuels market expectations for wider price cuts across the entire EV peer group globally. The mechanism is pretty simple. When the market leader, TSLA, is perceived to be struggling for volume in a key market, the general assumption among investors and analysts is that TSLA will likely respond by adjusting prices further to defend its market share.
Which forces everyone else's hand.
Exactly. That action forces every other EV competitor to at least consider similar pricing adjustments to stay competitive. And that generally squeezes profitability right across the board. This pressure on margins is immediate, in terms of market perception, even if the price cuts haven't actually been officially implemented yet.
Okay, but that brings up the point about sentiment bleed you mentioned, which is critical for names like FF Ford's direct EV exposure in China is pretty minimal compared to TSLA, right?
Relatively, yes.
So why do they feel the pain? Isn't it a bit generalized, maybe even lazy analysis to punish them equally?
It might seem that way, but the mechanism that ensures that sentiment bleed happens is really the analyst consensus linkage. Investors, rightly or wrongly, look at TSLA's performance as the leading indicator for the whole macro environment of electrification. So when TSLA stumbles in a core market, apparently due to price and feature competition, the market immediately projects that dynamic onto other global players.
Ah, okay. The assumption is if it's happening to them there, it could happen everywhere or to everyone.
Precisely. The market assumes that the price war in China signals a future of structurally lower average selling prices for all EV manufacturers worldwide. This collective sentiment puts immediate pressure on stock valuations for the entire peer group. So even if F isn't losing sales directly in Shanghai from this, the projected future profitability derived from the belief that EVs commanded a high premium that gets instantly revised downward.
Because of the perceived onset of a more aggressive global price war?
Exactly. They suffer via stock valuation adjustments. The mechanism is that projected future margin compression, driven by expectations of a price response from the market leader.
Got it. Okay, second category facing headwinds, battery materials and lithium producers.
Yes, this includes names like ALB, and ALTM. Their fate is tied very directly and pretty rapidly to the rate of BEV production volumes.
So what's the specific reason they're under pressure here?
It's that the softening demand for BEVs, combined with that aggressive price competition among the automakers we just discussed, transmits pressure directly upstream into the supply chain. This pressure quickly weighs on near-term order volumes for materials, and it negatively influences the pricing sentiment for core materials, specifically lithium. We probably need to examine the inventory and procurement cycle to see just how quickly this can happen.
Right, this is where we need to trace that upstream effect. A slowdown at the retail level, consumers deciding not to buy that new EV translates quickly into caution and potentially commodity price instability at the raw materials level. How fast is that process typically?
It can be surprisingly fast, largely because of inventory management. When automakers, and especially the major battery manufacturers, think CATL in China, for example, when they see weak sales data like this, they immediately adjust their inventory levels and their purchasing forecasts. Lithium isn't usually bought daily, right? It's procured under longer-term contracts, supplemented by shorter-term spot market purchases. And because lithium requires long lead times for planning, processing, procurement, any indication of weak future demand like TSLA sales drop signals to the battery producers that they might soon have excess inventory of finished batteries or cathode materials.
So they pull back on new orders.
Instantly, they reduce new orders for the raw material, specifically lithium carbonate and hydroxide. And since these producers, ALB and ALTM, operate in what's essentially a commodity market, any perceived reduction in global demand immediately leads to a decline in spot pricing. It also gives the cell manufacturers more leverage during any ongoing contract renegotiations.
So the downturn in TSLA's retail figures quickly translates into tangible purchasing caution among the battery ecosystem.
Absolutely. And that directly impacts the profitability of the raw material producers. Their financial results are highly sensitive to the price they can get for their output, making them pretty immediate victims of retail softness, even if it originates in one specific market.
Okay, that linkage is clear. Now, the final category of companies facing headwinds, which might seem a bit geographically distant from the Chinese sales data initially, is U.S. charging networks. This includes names like CHPT, and BLNK.
Yeah, their business model makes them quite vulnerable to generalized negative sentiment about global EV adoption rates.
So the reason for their vulnerability is tied to the basic economics of infrastructure, isn't it?
Exactly.
The slowdown in BEV sales growth expectations, or even just the perception of a slowdown, directly weighs on the future utilization ramp of that charging infrastructure. These networks are extremely CapEx-intensive businesses. They require massive upfront capital spending for hardware, land leases, electrical upgrades, all with a potentially long path to actually making money.
That's right. They're built based on the expectation, the forecast, that ever-growing numbers of EVs will eventually drive high utilization rates. High usage is the necessary path to profitability for them.
So that utilization curve is really the key metric.
It is. If fewer EVs are sold, or even if the rate of EV sales growth slows down globally, which the China data might suggest could be happening due to price resistance, then the timeline for achieving high utilization and financial break-even gets inherently pushed out.
Further into the future.
Right. And these charging networks are often funded by investor capital and debt markets. They rely heavily on the promise of future volume to justify the costs they're incurring today.
So when global EV sales signals turn weak,
The perceived risk profile of these assets increases. A deferred break-even point means investors have to wait longer to see a return, which tends to negatively impact funding sentiment. It can become harder for companies like CHPT and BLNK to raise the necessary capital, whether through equity offerings or securing favorable debt, that they need to expand and maintain their networks.
so the weakness in China becomes a factor in U.S. funding conversations.
Exactly. Because it suggests that the projected consumer base for their charging stations might be growing slower than initially forecast. This interdependence really demonstrates how a localized sales issue in one region can affect the sentiment around the infrastructure supporting electrification across the globe.
Okay, so for those who are monitoring this rapidly evolving segment, the analysis points to 3 specific metrics that are crucial to watch going forward. These are the indicators that might give the earliest read-through on whether the trends we've discussed, that rapid transfer of market share, the resulting price pressures are accelerating, maybe stabilizing, or possibly even reversing. First key monitoring point: TSLA China monthly data.
Yeah, that seems obvious but critical.
You need to focus on TSLA for immediate volatility, specifically around the release of that China monthly sales data. It acts as an immediate barometer for global EV sentiment and margin expectations.
And beyond just the raw volume number, it's imperative to track the commentary around the export mix from Shanghai. This gives really crucial insight into TSLA's current strategic priorities. We established that paradox earlier. High exports seem to compensate for weak local demand. Moving forward, you need to try and determine, is the plant primarily serving local demand again? That would indicate a genuine recovery in consumer appetite there. Or is the facility still compensating for persistent weak local sales by pushing an ever larger proportion of its vehicles overseas?
What would be a concerning trend there, percentage-wise?
Well, just as a guideline, a highly concerning trend would be if that export proportion consistently stays above, say, 50% or maybe even 60% of the total output from Shanghai, especially if the total production volume remains high. A high and growing export mix, even if total production is stable, it suggests that the underlying problem of structural localized demand weakness hasn't really been resolved. It would mean TSLA is still relying heavily on global markets to absorb the capacity that was initially built to serve China.
Okay, and conversely?
Conversely, a month where local sales rise substantially, even if exports moderate a bit, that would be a strong indicator of some recovery and maybe competitive equilibrium being reached.
And when looking at that monthly data, we should pay attention not just to the dramatic year-over-year change, like the one we saw this month, but also the month-over-month trajectory.
Absolutely. A stabilization or even a moderate rebound in local sales month over month, even if it's still below previous peaks, would suggest that the competitive and pricing pressures might be reaching some kind of temporary equilibrium. But if the rate of decline accelerates or just stays flat at these low levels, it confirms the persistence of those fierce domestic headwinds. It reinforces the argument that the domestic players are successfully pushing the foreign competitor out of certain segments, perhaps.
So this data isn't just about TSLA's operational performance. It's like reading the pressure gauge for the competitive health of the whole Chinese EV market.
I think that's a good way to look at it. Okay, second key monitoring point. Tracking the relative strength in EV ADRs, American Depository Receipts. This provides a direct, immediate measure of investment preference during periods of sector stress.
How does that work exactly?
Specifically, you track the performance comparison between the China ADR EVs, primarily NIO, and LI, versus TSLA, especially whenever new CPCA data, that's the China Passenger Car Association data, shows downticks. This direct comparison reveals which group the market currently favors during these periods of softness.
So, for example,
If, let's say, a soft CPCA report comes out and it causes TSLA's valuation to drop by, say, 3%, but the Chinese peers, NIO and LI, remain flat or maybe even gain a little,
okay,
that indicates a clear market belief that the local brands are successfully insulated or maybe are even actively benefiting from the difficulty of the foreign competitor. The market views the struggle as potentially a transfer of market share, maybe a zero-sum game within that specific sector, at least in the short term.
So this metric is less about the raw sales volume itself and more about investor conviction and the market's working theory at that moment.
Precisely. If investment capital is seen moving out of TSLA and simultaneously into NIO or LI on the same day the weak China data hits, it tends to validate the analysis's categorization of winners and losers. It suggests investors believe the contraction is somewhat localized to the foreign brand, not necessarily a generalized macro problem hitting all EV adoption in China.
But what if they all fall together?
Right. If, however, both TSLA and the Chinese ADRs fall equally or proportionally on the news, that might suggest a broader macroeconomic concern impacting the whole sector, potentially overriding that competitive transfer narrative. So tracking the differential performance provides immediate insight into the market's working interpretation of the competitive dynamic.
Okay, clear. And the third key monitoring point.
Finally, we need to monitor the lithium market updates.
Right, back to the raw materials.
As we detailed when discussing the material producers, that segment is directly affected by changes in BEV demand projections and the competitive pricing environment.
So specifically, you should monitor spot and contract updates for lithium pricing.
Exactly. This provides a direct reading on the sentiment and the expected near-term orders for producers like ALB, and ALTM. A sustained drop in lithium pricing or consistent downward pressure during contract renegotiations suggests that the battery manufacturers and the automakers are anticipating a prolonged period of softer demand. Or, alternatively, it could mean the price war among automakers is successfully squeezing material costs out of the supply chain.
So the lithium price acts as a kind of proxy for the entire EV supply chain's confidence about future production.
It's a pretty good proxy, yes.
Yeah.
Because lithium often requires significant lead time for procurement. Any volatility there indicates a lack of clarity regarding future BEV production schedules among the major manufacturers. If the weakness we observed in TSLA's sales figures translates into a prolonged downturn in lithium pricing, it provides a factual basis for assessing the magnitude of that upstream impact we described.
And if we start seeing reports of producers delaying new mining projects?
Or mothballing capacity, yes. That signals that the perceived supply overhang, driven by softening retail demand expectations, is now becoming structural, or at least viewed as such by the producers themselves.
Okay, that brings us towards wrapping up.
Yeah, I think a concise summary of the findings is this. The struggle for localized Chinese retail sales, specifically for the foreign competitor in this case, isn't just a company-specific event. It appears to be a multifaceted occurrence. It seems to be simultaneously boosting domestic rivals and the appeal of hybrid technology options, while also creating economic pressure for infrastructure providers and raw materials producers further upstream. The implications are broad, potentially affecting the entire global vehicle electrification strategy and the financial structures that support it.
And the data really does strongly indicate that these domestic players are gaining ground, partly by moving faster with new models and using aggressive, localized pricing strategies, which forces us to consider a key question for the future, maybe a provocative thought to leave our listeners with. If the market's growing preference for hybrids in China is truly an affordability bridge for many consumers right now, what happens to the projected global BEV adoption rates if those same domestic Chinese brands also successfully dominate the budget EV space? Not just hybrids, but low-cost BEVs too. The competitive landscape for global players who rely heavily on pure BEV volume could become considerably more challenging, couldn't it?
It certainly could. It raises questions about global strategies and cost structures.
Definitely something to watch.
Okay, and before we finish, just the necessary reminder. Please note, this conversation is not intended as financial advice or buy or sell recommendations. This presentation is purely based on the opinion of the author of the material we have reviewed.
Absolutely. Thank you for taking this journey into the material with us today. We'll talk soon.